I'm joined by Graham Bell. He's a strategist at Old Mutual Equities. Graham, so good to have you with us today as always. For a moment, Greece is on the back burner, which comes as much relief to investors who might be fatigued by Greece headlines. But let's turn our attention on to the US. As we've all known, all eyes have been on the Fed for quite a while now, given the fact that they will increase interest rates before 2016. But now that we have that confirmation from Janet Yellen herself once again, does this guarantee some kind of certainty in the market going forward?
Hi, Gugu. Well, the US rate consensus has been converging on September now for many months. So it's no surprise that Janet Yellen is helping us to get to a date that we can all agree on. Of course, it's always data dependent, so in the next few weeks we might get data which makes us think otherwise. But at the moment, that's where we are at the moment. A September rate hike doesn't mean that rates will then go up every Fed meeting for the next year and a half. Quite the contrary, Janet Yellen has been very careful to guide that it will continue to be data dependent, and so each Fed meeting will have to wait to see what the data is going to be, and it's quite possible that the glide path for US interest rates will be very gradual in this cycle.
Having said that, Graham, would we be worried about what the impact will be on emerging market and especially South African fixed income markets?
Look, as I've always said, and we've chatted about it a few times, probably volatility does pick up as the actual day arrives or just before the day arrives. But because the Fed has been so careful to guide for such a long period of time, and the expectations have been converging around September for so long, it looks like the amount of volatility will actually be pretty limited. And you know, as we've seen, there have been loads of other events which could also have caused volatility over the past few weeks. Indeed, you mentioned that Greece is off the headlines, but in fact, we might find that Greece is right back in the headlines by the end of today, because there's a very important vote taking place in the Greek parliament right now. And Alexis Tsipras and his party need to make sure that no more than 40 of the so-called rebels within Syriza vote against this program, this new deal. So you know, the opposition party comes to his support, but he needs to have at least a minimum of his own party to be on his own side. If that doesn't happen, then you know, we're back into turmoil again. But the most interesting thing, I think, of all of these things, you know, we had the Chinese market going up and going down. We've had this Iranian deal that suddenly had a historic close yesterday, and through all of these periods and bouts of volatility and negotiations that have been fraught with tension, markets have actually been pretty steady, bond markets and equity markets. Been some sell-offs here and there, but very quickly they've recovered their ground. So I don't think we should be too concerned about the Fed, about Greece, about China or anything else. I think the underlying global growth situation is still pretty steady, and I think there's good reason for equities to continue to perform.
What about China? Because that's obviously the key area of concern still. Should we still be nervous about what's going to unfold from that particular region?
Yes, because there's a lot of margin credit. So people have been able to borrow to buy into the market. And it's been particularly in the retail market, it's been a close your eyes and buy in China until very recently. And then it became close your eyes and sell. And there's a huge amount of margin lending. People don't really know exactly what the number is, but it went from something like 200 or 300 billion renminbi last year to probably something like 2.5 to even 3 trillion renminbi in a very short space of time. So people are borrowing to make money, and of course, when it goes the wrong way, they then have to extinguish those debts, and they get called, and they can get into a horrible amount of trouble. And there's still quite a lot of margin credit out there. It's contracted a bit, but it's still there. So it's uncertain. We don't really know, but the market is not nearly as expensive as it was, particularly the H shares in Hong Kong, and so there's been a pullback, and the underlying situation, as you mentioned just now, there's been some pickup in the growth, so there's probably some improvement in profitability for Chinese companies. So some volatility still, but I don't think it's an all fall down situation which could cause disruption globally.
Does this then present a buying opportunity for quality stocks from a global perspective?
Yeah, there's always quality stocks is where you want to be, and any pullbacks would be an opportunity to get into good high quality equities with good growth potential. Those with decent dividend yields are also, also offer good opportunities, and that's what investors should be looking out for.
Well, should we be nervous about the oil impact then, and maybe be very careful when it comes to selecting oil producing companies, given what we're seeing unfolding with the oil price as well as deals around Iran that you alluded to earlier?
Look, the oil market is complicated. Certainly Iran will be coming on with more oil over the next year. But this, of course, is dependent on the US Congress passing this deal. It looks like it will be very difficult for the Republicans to oppose it, because at the end of the day, they would actually have to have a 2/3 majority in both houses of Congress to override any veto from the president. So it looks like the deal will go through. So therefore, Iran comes back into the market with up to another 1 million barrels of oil over the next year. You've also got Iraqi supply picking up, has been picking up, and then the Saudis are still threatening to increase their supply. So there is a lot of oil around, and it probably is going to hang over the market for a while. But demand for oil has also been quite buoyant, and so global oil demand is probably rising at like 1.5 million barrels of oil a day year on year. So by this time next year, that extra demand will have been able to absorb quite a lot of extra supply. So in the short run, I think probably some downward pressure on oil, but looking out a year or two, with the demand picking up and resource depletion, particularly in some of the US shale oil fields and so on, probably some pretty solid support for the oil price coming through down the track.
Graham, thank you so much for your time and analysis of the global market space, giving us his local view. That was Graham Bell, who is a strategist at Old Mutual Equities.